My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be able to make friends. I'm just trying to save you a little money. My job is not just to entertain, but to educate and to teach you about this market. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. The battle between truth and fiction plays out every day in this market, and sadly, fiction usually wins. That includes days like today, where the Dow shed 181 points, S&P declined 0.76%, and NASDAQ lost 1.15%. After a tremendous run from the lows last fall, things really have turned nasty, haven't they? I'm starting to see that same old negative ennui creep back into the market. We're plagued by imaginary scenarios that we're somehow convince ourselves represent reality and make us say, who needs this nonsense? Let's just go sell everything and buy some bonds.
House of pleasure.
The first absurdity, the first fantasy, that somehow there's a correlation between the newly weak bank stocks and reality. Because these bank failures last spring have left a nasty taste in our mouths. But the truth is, the vast majority of banks are actually doing quite well in this country. They aren't going to be able to loan aggressively, but guess what? They weren't doing it anyway. So let's just stop the extrapolation, please. Almost every class of loans is doing great, from credit cards, mortgages, home equity, small business loans. Even the dreaded office building loans are looking good, which are a very small part of every bank's portfolio. See, people have to realize that there are two kinds of buildings right now. There are the new ones with tremendous amenities to lure knowledge workers back to the office from home, and the old ones filled with support workers that are all execs are actually in a foot race to terminate. You only need to go on any of the retail conference calls yesterday and today to know that there are some headwinds, but the earnings are higher. We're even seeing strong numbers from the office real estate investment trusts and upgrades and price target bumps, too. Can we just say this whole low-end office building crisis is overblown? May not even be a crisis. And there's plenty of capital out there willing to buy any substandard building, and they can make a real deal. You know what? They might be able to turn them into residential housing, but you need some tax breaks to do that. I say enough lies and misinformation about commercial real estate. The lies are what's getting painful, not the news. Second set of lies, we are told to fear the stock market because the yield on the 10-year Treasury, roughly 4.25%, is closing in on the highs from last October, just above 4.3%. That was the highest it's been in 15 years. I've been saying forever that the economy is actually in good shape. Something the Atlanta Fed seems to agree with me on because they just said that the economy is growing. The GDP is growing at like a 5.8% clip. Holy cow! I say here we go again. We were supposed to fear the stock market when the 10-year offered low interest. Now we fear it when it offers high interest? Stop trading the darn bonds. Heads you lose, tails you lose. Give me a break. My view has always been that the longer-term rates, the ones that go out to 10, 20 years, they're way too low to begin with versus how strong our economy is. That's been my view for 2 years now. I've said that we need several more rate hikes by the Fed to get the economy to fully contain inflation. But the bears want to have it both ways. Somehow lower rates are bad and higher rates are bad. In this case, I think higher rates are fine, because they simply represent a return to normalcy. It's just that you need to be old enough to remember what normalcy looks like. Exhibit A. Now, the third lie is that the consumer is getting weaker. No, no, and no. The consumer is a changed beast, though. She doesn't do what she did before COVID because her life's different. She may work at home. She may want the convenience of Amazon, which sends 375 million packages on Prime Day? Don't you think that changes the equation about retail and brick and mortar? I do. I think it's mighty hard for anyone to compete with that. As Target showed today when it reported weaker same-store sales, even as it made a boatload of money thanks to inventory control. Home Depot, on the other hand, had a magnificent quarter. It's always been hard to compete with them. And Amazon certainly doesn't do a great job of selling housing supplies, ladders, that kind of thing. As wash machines. As CEO Ted Decker explained on Home Depot's excellent conference call, quote, our consumer is a homeowner. 80% of them own their homes, up tremendous equity value in that home, great jobs, great income, and it's a very healthy consumer segment in the overall economy. Come on. Do you trust the people on Wall Street who tell you that everything's are bad? I'm going with Ted Decker. Actually, I could have gone very fine, extremely fine, but I thought fine was just fine. But it's not such a good time for many other brick-and-mortar retailers. Personal story. Okay, so yesterday morning, I wear contacts. I don't know about you, but I do. I ordered a contact lens solution from Amazon. It was the one they recommended. It seemed like a water like everything else, you know? Yesterday evening, it was on my deck when I got back from work. That's what I ordered in the morning. Oh, there it was. It's so much easier to buy this stuff from them than rather than going to Walgreens and wait for a clerk to come open that plastic case where they now have to hide the stuff. Pilfer's is rife, which we also heard from Target. I didn't need the stuff. I could have waited a day for the solution. So could you. So before we decide the consumer's week, I argue that the consumer's just not going to the same place anymore. Everybody loves a bargain, hence the strength of Amazon. It's also why Cramer fave TJX right down the block. I got a pair of jeans for $14. I'm telling you, I saw they're worth like $140. TJX just delivered a monster quarter. I mean, it was incredible. I was particularly pleased to see that Marshalls did well. That's where I got my first corduroy suit. Home Goods did well, too. Don't forget, if you're going to get that stuff for Thanksgiving, you got to go now because they run out so fast. They're nice bellwethers, and they expose the lie that the consumer's hurting. Fourth lie. China can and will bring us down. Now, 8 years ago, the Chinese stock market was collapsing every day, and we were told it would crush us. Yeah. Now we hear their wayward trust in clown show real estate developers are just going to crush us. I mean, it's going to be like a nightmare. Listen to me. I am concerned about the bizarre Chinese weakness, but I keep thinking back to what stopped the selling in their stock market just back then. I actually was doing a lot of work on it last night while I was doing my speech for tomorrow with the people in the investment club. I was trying to figure out what made that sell-off stop. Well, guess what they did? They made it illegal to sell. Now, if they did that here, our investment bankers and sharp traders would quickly figure a way around it. But in China, financial crimes can be made into capital crimes. If the ruling Communist Party says that no one can withdraw money from troubled institutions, and they do, they can do whatever they want, for heaven's sake. But did you know it's like a communist dictatorship over there? I mean, maybe we ought to remember that. It's an authoritarian government. You can do whatever you want to change whatever you want. So I'm not buying the theory that China's economy will bring us down. Even as I think their government's ham-handed and sometimes hapless, I'm surprised that they don't give some of these trust execs life in prison for stealing money. Maybe they will. The Chinese government isn't eager to air its dirty laundry. Final lie. Tech is over, and that means the bull market's over because the bull is all tech. Oh. I'm very sorry, but during our fabled chart week, we had the legendary Larry Williams come to town. Long before the current bout of selling, he said he made it clear that August would be a tough month for the market. And what did he say? He cautioned P. That's right, he cautioned for patience. That meant you had to be willing to watch your favorite techs get hurt. Now, of course, nobody wants to suffer through the stocks going down. Everyone's conditioned to get out immediately in order to conserve capital. But the other day, I was looking at a tape of the old day on CNBC, and I watched it crawl, the ticker go by, and also prices of stocks that might have been sold 10 times between then and now. If you got spooked, you would have missed out on some tremendous multi-year moves. That's why patience pays off. Plus, tonight, networking giant Cisco and semiconductor designer Synopsys reported amazing numbers. We'll talk to Synopsys later in the show. So think of these fictional narratives. The bank's going to take us down. Higher interest rates are going to crush us. The consumer's weak. China can take us down with something like a drowning swimmer, you know, when you go out there and try to save it, like life-saving, and tech's finished. I think these are nightmares that will not be realized. Stephen King is not in charge. Bottom line, lies thrive on Wall Street, either thanks to ignorance or thanks to money managers with a vested interest in pushing stocks lower. But I'd much rather bet on the side of the truth. I don't know. Truth tends to work out. It sticks. And right now, the truth is much better than you might think, considering the recent action. And I wouldn't find myself bailing here. Patience is warranted. How about we start out with Jerry in Missouri? Jerry!
Hey, Jim. Thanks for taking my call.
My pleasure, Jerry. What's up?
You've spoken to this company on your show often over the years. You seem to be a fan. But with the tech downturn this month, I want to know if you still consider Shopify as its stock to own.
Okay, Shopify is the small or medium-sized person's Amazon for fulfillment. And Harvey Finkelstein does a great job. My belief is that Shopify is a hard stock to own. I admit that. But longer term, I think it's going to be great from all the way down at these levels. Okay, listen to me. Lies thrive on Wall Street. But I'd much rather bet on the truth. Oh, man, buddy, tonight, as part of the Inflation Reduction Act, Medicare was given the authority to negotiate directly with the drug companies in order to lower the cost of brand name medications. The drug manufacturers are finally fighting back. What should you make of all this? I'll give you my take. And subscribers to the CNBC Investing Club know we're laser focused on Ford. So what could a UAW strike mean for the auto cohort as a whole? I'm digging into the latest situation. And as I mentioned, Synopsys announced big leadership change after the close. They did great, though. I'm running through the announcement and those fabulous earnings. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.